Welcome to The Truth About Taxes and Retirement. This podcast is brought to you by SavingYouTaxes.com and hosted by J. Barry Watts. As an advanced tax strategist and enrolled agent federally licensed by the IRS, Barry is uniquely qualified to go deeper into the Internal Revenue Code than most accountants. He understands and interprets its provisions, explaining how they'll help you reduce income taxes you owe so you can direct that previously wasted tax money into tax-free accounts that you can enjoy in your retirement years. Now, on today's episode.
Hello, I'm Barry Watts on The Truth About Taxes and Retirement, here to talk with you about what people don't know about taxes. Now, this could be a pretty big book because taxes can be intimidating. The tax code itself has over 70,000 pages, and the government forms appear ominous. But it's really not that scary if you understand it. And so today, Patrice Sikora and I are going to help you unpack some basic things that you can learn about taxes that'll make it easier for you to be comfortable in dealing with paying your government. Patrice, welcome to the show. How are you today?
70,000 pages. Wait a minute. Now, how many pages was War and Peace?
You know, we should Google that. The only problem is how long it takes us to Google, and I don't have a Google window up. But one time I used to know the answer, and I don't now. I took out one of my Bibles and I saw how many pages it was, and I don't remember what the number was. Maybe like 1,600 or something. And you know how intimidating the Bible is to everyone in terms of being able to master what it says. So imagine that your challenge is to master the tax code. And I have had CPAs come in my office and sit down and throw all their stuff on the table and say, Barry, I have no idea how this works or what this is. And so what we want to do is we want to help people get their hands around this because we deal with it daily. Now, I haven't mastered all 70,000 pages either. The CPA who works in my office hasn't mastered all 70,000 pages, but we do know some interesting things from the tax code that help people to reduce their income tax. And so today we want to enlighten you on those things and help you have a little more brightness in your mind when it comes to understanding how taxes work. And maybe in the process, we'll understand how Texas works as well.
I'm not sure we can ever understand that.
I think I slipped in when I said that. But anyway, Patrice, you ready to go?
I am ready.
All right. First thing we're going to talk about is death and taxes.
Benjamin Franklin.
Yeah, Ben Franklin did say that the only two things you could count on were death and taxes, and he was right. You know what percentage of people actually pay a tax when they die, Patrice?
I would guess it's a lot. The estate tax, is that what you're talking about?
Well, okay. That's the question. What tax are we referring to? The answer is roughly half of Americans will pay a tax of some form when they die. Now, this is not the dreaded estate tax that you hear so much about. Only about 0.1% of people who die will owe estate taxes. Now, just so you know how estate taxes work, in 2024, this year, if you died, you can pass on $13.6 million to your heirs estate tax free. So a couple could pass on a little over $27 million to their heirs tax-free, and that pretty well covers most of our clients. So most folks fall under that $27 million number. Yet 50% of Americans will pay taxes when they die. How is that even possible? Well, here, it's real simple. If you die with money in a 401k or a traditional IRA, all of that money in that account is going to be subject to taxation. Dying doesn't get you out of it.
I'd like to see them come and get me.
Yeah, they're not going to come get you, but they will come get your estate and they will come get your heirs. So they will pursue this. The average balance in a 401k IRA account is a little over $100,000. And so that's a minimum of $10,000 in taxes due for dying. And in some cases, it may be as much as $22,000 or $24,000, could be as much as $37,000, depending on the size of the estate. And that's only to pass on another $100,000. So what you need to think about is while you may not qualify for estate taxes, you will qualify for death taxes if you have an IRA account, because taxes will be assessed against your IRA and 401k accounts and it will be taxed at your heirs' tax rate. So if they are doing really, really well, then the amount of tax that they have to pay could be higher than the amount of tax that you have to pay. This is the story in my family. Now, my mom and dad have done very well, and they have a lot of assets, and they're getting on up in age. My brother and I are doing extremely well in our respective businesses, and puts us in the top tax bracket. And so, one of the conversations that I've been having with mom and dad is, look, you can pay the tax on this money now at your rate, or you can wait and give this money to me and my brother, and we'll pay tax on it at our rate. And if we're viewing it as family money, then it makes sense to pay the tax on it at the lower rate today for mom and dad to do that than for my brother and I to pay tax at the higher rate. Now, I do have clients who say, well, I don't care how much tax my kids pay. I'm not interested in paying my kids taxes for them. I think that's a little short-sighted and a little hillbilly-esque, frankly. Because the simple fact is, we're talking about how much money there is in your family, for your children, for your grandchildren, for you to do all the things that you want and need to do. And I think you need to realize that if you can pay those taxes more cheaply yourself than passing that money on to the kids and having the kids pay the tax out of the exact same pool of money, but only pay it at a higher rate, it makes sense to pay the tax now. So
they will love you for this, right? Your children will love you even more.
Your children are either going to love you or they're not going to love you. And I'm not sure they'll know that you even did this for them. We have a lot of trouble communicating with families about this kind of stuff because people don't get it. They don't understand. They don't know what's going on. In fact, we had a call just yesterday from a CPA client. This person is a certified public accountant, and they're all up in arms and all upset about 16 different things, none of which are accurate, none of which are right, none of which are true. The problem is they don't understand. And so once again, we sat down and explained it to them again. And that's how we do things at the Wealth Care Corporation. We want you to understand. And so with regard to death taxes, if you want to understand and want to avoid those to the greatest degree possible, then why don't you come see us and let us help you at the Wealth Care Corporation? You can just visit our website at savingyoutaxes.com. And we'll be delighted. You can fill out a form there and send it to us, and we'll get back in touch with you, or you can actually just call us direct if you want. The number is 417-882-1726, 417-882-1726. And we'll set an appointment to talk with you about your situation and see how we can help you. All right, Patrice, let's talk about the second tax that people don't really understand. Are you ready?
Let me guess. Social Security taxes.
It is.
That is a tax?
And you, by the way, are you taking Social Security? Have you reached the magic age yet?
Yes, I have. The maximum magic age.
Well, I didn't know which side of that fence you were on. I couldn't remember clearly. So you know how this works then. A lot of people, though, aren't even aware that they can pay taxes on Social Security because it used to, a long, long time ago, Social Security was not taxed. But today, the Social Security Administration says 40% of recipients pay taxes on Social Security. Now, the reason that they have to pay tax on Social Security is because they have other income besides Social Security. And isn't that a good thing? To have other income.
So it is.
What counts as other income? Well, it could be a pension, because I know you get that big check from Bloomberg where you used to work. Yeah. It could be that you've got money in investment accounts and it's paying out dividends and interest, or it could be that you've got retirement savings, that's IRAs or 401ks, and you pull money out of that. All of that counts as this thing I'm calling other income, which drives taxation of Social Security. Now, when you start making required minimum distributions at age 73, this is when sometimes Social Security gets attacked, because if you didn't need the money and you're not taking it out of your IRA, you're okay. Maybe you aren't even paying a tax on your Social Security, but now you're 73. You have to make required minimum distributions. And the first important thing to understand is they're required. You don't get to step around these. And the amount that you have to distribute is controlled by the government. And the tax rate at which it will be taxed is controlled by the government. And all money that you take out of 401k and IRA accounts counts in determining the taxability of Social Security. It's something that they call provisional income. Now, if I were going to name that, I would probably name it the money you make that determines whether Social Security is taxable. That's
I like it. I like it.
That's cumbersome, but at least you understood what it said. But no, the government calls it provisional income. And so what they do is they tally up all of your income from all of its sources. So your pensions, maybe if you've got a farm, like a lot of my clients do, you sold a load of cattle. All right, there's that. Maybe if you've got a rent house or you even inherited part of some commercial property and that money comes to you every year, that counts in the mix. I already mentioned pensions, I think. So everything, interest payments coming from the bank, if you've got money in a CD at the bank, that counts against Social Security. They tally all this up, including tax-free municipal bond interest.
Wait
Isn't
a minute.
it interesting?
Wait a minute. Tax-free municipal bond interest.
Yeah, tax-free bonds are not tax-free. Now, tax-free bonds don't charge you income tax on the interest from those bonds federally. And if it's a tax-free bond from your state, they don't charge you income tax on the interest from that bond in your state. But if it's a bond from out of state, they'll charge you on it. But all of that gets erased and goes away when it comes to figuring out your provisional income to see how much tax you pay on Social Security, because your municipal bond interest goes into the calculation. So let's say you were really rabid about this and you said, I want everything tax-free. I'm only going to buy tax-free. And you got locked on to tax-free municipal bonds. And I know there are some people who are this way because I've dealt with them in the past. And all you owned was tax-free municipal bonds. Let's say you had, I don't know, $5 million worth of them, bunch of them, a lot of money in taxed-free bonds.
That's a big ouch.
It'd be a big. It's big whether it was 500,000, let alone 5 million. Probably more people listening would come in here having 500,000. But the point is, all of that interest that you receive that's tax-free, because you're so diligent to keep yourself in a tax-free position, all of that interest counts against Social Security to determine whether it will be taxable. In fact, 1/2 of Social Security itself goes into the calculation to determine whether it will be taxable. And, for the past 3 years, over the past 3 years, your Social Security check itself has increased by 18% over the past 3 years. So the point is, even just as Social Security cost of living kicks in, that cost of living that kicks in on Social Security is one of the things that can actually cause Social Security to be taxed. So let's talk about how Social Security is taxed in terms of what the tax percentages are. So it starts out untaxed. The way to think about it is nobody pays tax on Social Security until you get to $32,000 in income married or $25,000 in income single. And when you hit that barrier, and most people will hit that barrier, then 50% of Social Security is going to be taxed. When you get to the $44,000 married amount or the $34,000 single amount, that's 44,000 married, 34 single, then 85% of Social Security is taxed. So for most people who are going to pay a tax on Social Security, they're going to be paying tax at that rate that 85% of their Social Security is taxed. Now, here's kind of an odd thing about how the government works. Those rates were set in 1983. 41 years ago, they set those dollar figures. If you go back 41 years and think about the money people were making 41 years ago, think about how much money you were making 41 years ago. Probably nothing compared to what you make today. And that's how taxes go higher. They set those numbers 41 years ago, and they never have moved the numbers up with inflation. For example, $1 41 years ago, just at the rate of inflation we've experienced in the United States, is $3.14 today. And so what that means is if Social Security tax brackets had increased appropriately, you wouldn't pay tax on Social Security until you were making around $100,000 married. So every year, more and more people get sucked into this because the brackets aren't moving. Now, this is all bad news, Patrice. I've got one little glimmer of good news. There are some states that do not tax Social Security, and I'm for that. I think they shouldn't. And by the way, one of the states that does not tax Social Security starting in 2024 is the state of Missouri, where we are headquartered. And so good news for our listeners who are here in the Show Me State. No Social Security tax this year from the state of Missouri.
You say this year. Why do you say that? Why do you qualify it?
because the law just changed. In 2023, there was a tax, and the
Oh.
new law that was passed went into effect on January 1. And so from this year forward, there will be no tax on Social Security.
Until they change it again.
Well, I don't think that one will probably get changed. There's enough. I'm telling you, the peasants with the pitchforks. The peasants with the pitchforks. Did you ever meet Pat Buchanan?
I've never met him. No.
Well, show us how old we are, because there's some young people who listen to this show. They have no idea who I'm talking about. There was a guy back in the day when Ronald Reagan was president, who was he was a kind of a right-wing Republican, rabble-rousing kind of guy, and he gave this great speech. Say again?
I said kind of?
Yeah, well, okay, all right, so he was. Anyway, he gave this great speech at the Republican National Convention, and I always have remembered it. He said that if they don't straighten up in Washington, peasants with pitchforks are going to march on Washington. And that just kind of resonated with me because, on the weekend when I'm at home, you know what kind of clothes I wear? I wear overalls because I'm on the farm.
Yeah.
And I handle pitchforks multiple times a week on the farm. So when he said peasants with pitchforks, I could see it because those are my people. I understood it. And some of you understand it too. You're thinking about your grandpa or your Uncle Elmer or whoever it is. He kind of dresses like a peasant, and you've seen him with a pitchfork. It's sort of American Gothic all over. Ooh, I had to show you that I was a little bit sophisticated. American Gothic is that picture, the husband and wife standing side by side, and the husband's got the pitchfork in his hands. So the whole idea is that if the government pushes us far enough, and this may be kind of what we're seeing out of Texas right now, by the way, is the peasants with the pitchforks will march on Washington. And they'll put Congressman Burleson, my buddy, Congressman Burleson, and all those other folks on the end of the pitchfork and say, now, looky here, straighten up. We don't want any more of this. And there's a lot more to it, but I would say that's a little bit of what's going on with Governor Abbott and the Texans today. So anyway, if you'd like to avoid taxes on Social Security, just call the Wealth Care Corporation, 417-882-1726, and say, I want an appointment with Barry to talk about taxes on Social Security. And they'll say, well, okay, here's an appointment time. And if I'm totally booked up, as I kind of am right now for the next several weeks, well, they may put you in touch with one of our other advisors, but we'll get you taken care of because we can help you on that. Call 417-882-1726. And that's how you reach the Wealth Care Corporation. All righty, Patrice, we're ready for the third tax. Are you beaten up by taxes yet?
I'm getting there. A little black and blue here. Third is Medicare tax.
Medicare tax. That's exactly right. Now, most people don't even know you have to pay to receive Medicare. You do have to pay to receive Medicare. You've paid into it all these years. But then when you go on Medicare, there's something called IRMA, and that's an acronym for words I can't remember off the top of my head. But we just refer to it as the Medicare tax. It's a premium that you pay to be covered by Medicare. And for most people, it comes right out of their Social Security check. But if you're not on Social Security yet, and you're already on Medicare, meaning you delayed Social Security till 70, but you started your Medicare at 65 because that's when you do it, well, then they'll send you a bill for it and you have to write them a check. Now, it's based on the amount of your income. And for example, if your income is less than $103,000 a year, well, it only costs $174 a month for your health care covered by Medicare. And so for a husband and wife, that's going to be $2,088 per year. No, that's not husband and wife. That's just one person. Am I correct? What is 174 times 12?
Let's see. We can get our little calculator.
It's $2,088. Yeah, so that's per person. So husband and wife would be $4,176 if I did my math correctly. So that's the cheap way. But when you start making more money, for example, if you go into the $103,000 to $129,000 bracket, it moves up from $174 to $244 per person per month, or $2,900 a year per person. And in the top bracket, if you're making over $500,000 a year, and God bless you, I hope you are, well, then you're going to pay $594 a month for your coverage by Medicare. That's a little over $7,000 a year for you, $7,000 a year for your spouse. So the point is, there is a Medicare tax, call it a premium, whatever you like. You have to pay it in order to be covered by Medicare, and it can get to be seriously expensive. And Patrice, I'll pause here and say, when I'm talking to people about moving money from IRAs into Roth IRAs, And everybody gets it because that's a good tax saving strategy long term. Well, the place that they always rebel and it hurts their feelings a little bit is because of what it does to their Medicare, because they have to pay so much more for Medicare right up front. So that is the painful part of it. It's not something we can avoid. You have to do it. And the bigger problem is Medicare runs 2 years behind.
That was going to be my point. Yes. Yep.
Well, this is 2024. So right now, Medicare is running on income that you got in 2022. So let's say that you do a Roth conversion today. You convert several thousands of dollars that drive you into these higher brackets. You won't know about it in terms of your Medicare costs until 2026.
And then suddenly, you'll find out big time.
Oh my goodness, I got all this extra Medicare to pay for. And you don't even remember that 2 years ago you did those conversions. So we spend a lot of our time reminding people about how this works and what's coming down the road. And what can happen is, again, at age 73, when you get those required minimum distributions, it can push you up those steps on the ladder and force you to pay more for Medicare. So I favor, instead of just being victim to the government, I'm going to pay when they say I should. I'm going to pay on the amount of income that they require me to. I'm going to pay at the tax bracket that they require. I'm going to be a sheeple and just obey the government. I think it's a really good idea instead to take control of it while you can and manage this yourself and pay some tax voluntarily, so that when that time comes, you don't get forced into these higher tax brackets on Social Security, on Medicare, and it's out of your control at that particular point in time. So if you'd like to minimize the Medicare taxes you pay, well, guess what? We can help you with that at the Wealth Care Corporation. So just visit our website at savingyoutaxes.com, and you'll be able to get in touch with us, and we'll be delighted to take good care of you. On to tax number 4. Are you ready?
You say charitable giving here. Never give money to charities, but that is not what we are told.
Well, actually, I am going to say never give money to charities. Never give money to charities. Now, having said that, let me explain what that means. I give a lot to charities, and so I'm not saying don't be generous. I'm saying be smart with your generosity. So let's say that you're going to give $1 to a charity. Well, in order for you to have that dollar, you had to receive it somehow. So let's say you got it in income, whether it came from Social Security or pension or your W-2 or whatever. Well, when you get that dollar, you pay a tax on it. So we like to say the dollar has had a haircut. Mm-hmm. And then you turn the dollar over to the charity. So if you give away $1, it costs you either a minimum of $1.10, and as much as, if you have state taxes involved and you're in the state of California, for example, it costs you as much as $1.50 to be able to give away the dollar, because you have to pay the tax on it first. So think about this. Instead of giving away $1, this is where never give money to charities comes in. Instead of giving away $1, why don't you give the charity an asset that doesn't have to be haircut? Well, what would that be, Barry? Oh, how about that stock that you had sitting in your account for 48 years? How about that Facebook stock that you bought that shot the moon? Or maybe you bought Walmart years ago, or whatever it was, because that stock has got taxes built into it. And if you sell that stock today, you're going to have to pay a tax on it. So some people say, well, I'm going to sell this stock and give it to my church. No, stop. Don't do that. Instead, give the stock directly to your charity. Give it directly to your charity. Now, here's why this is really important. Think about it. Let's pretend that you put $10 in the stock. So it was $10 per share. And let's say today it's $100 a share. All right. So if you sell that $100 a share and you only gave $10 for it, so you have $90 worth of gain. And you're going to have to pay a tax on that gain. Maximum tax on it right now would be $18, 20% on $90. But if you just give that money to the charity in the form of the stock, you give the stock to the charity, nobody ever has to pay tax on the $90 in gain. You won't pay the tax. The charity won't pay the tax. Uncle Sam got screwed. And I think that's a good thing. Because what goes around comes around. Just saying. All right. So there's one other thing about charities I need to talk to you about. Well, there's actually more than one, but here's another point I want to make. So let's talk about something called qualified charitable distributions. When you reach 70 and a half, you can take $100,000, any amount up to $100,000, and give it directly from your IRA or 401k to your charity. And there will be no tax on the principal, no tax on the gain. You have done what you needed to do in terms of qualifying with the government to avoid tax. So qualified charitable distributions are a tool that we encourage people to use if they are giving money to charities rather than giving them dollars. Give them money out of your 401k or IRA account, or give them money out of assets, stocks that have been appreciated in value, and you'll avoid the tax. The government doesn't get any tax money out of that. So if this is something that interests you and you'd like to manage your charitable giving or even to maximize your tax deductibility, well, call us at the Wealth Care Corporation, 417-882-1726, and ask for an appointment, because that's something we can help you with. All right. Speaking of charities, let's kind of keep the theme rolling here. This is the fifth tax people aren't aware of. Or it's a fifth tip, I should say, more than a tax. This tip has to do with bunching your charitable gifts, bunching them up together. Now, here's what you got to realize. Most people today file their taxes using the standard deduction. They can't itemize anymore because their deductions aren't large enough to be able to itemize. The Tax Cuts and Jobs Act of 2017 changed the rules, and a lot of people shifted from itemization to the standard deduction. And so that means if you're giving money to charity, you don't get direct deductions for giving that money if you're using the standard deduction. And by the way, that amount in 2024 is $29,200 if you're married, $14,600 if you're single. So unless your interest and your healthcare costs and the amounts that you give to charity exceed $14,600 single or $29,200 married, then you don't get to use that deduction. So I want to give you an example of how this strategy of bunching your charitable gifts can work and potentially save you thousands of dollars in taxes. And to do it, I want to tell you a story. The story is about bunching Betty and Standard Sam. Are you ready? Now, please. Betty and Sam don't know each other, but it does turn out that they've got a lot in common because they both give generously to charity every year. They make $8,000 in annual donations to their church and their children's schools and other charities. And so in 2023, just last year, they both have $17,000 in other deductible expenses like mortgage interest and maybe real estate taxes, something like that. So as a result, each of their households each year ends up with about $25,000 in tax deductions. Not enough to clear the hurdle to itemize, because the itemized deduction wouldn't kick in until $27,700. That's the standard deduction amount. So if you've only got $25,000 in tax deductions, you don't exceed the standard deduction, so you can't use your charitable contribution. And so in Sam's case, he uses the standard deduction of $27,700 because he only had $25,000 in deductions, and that was the right thing for him to do. And so for 2023 and in 2024, Sam is going to take just the standard deduction. But bunching Betty knows something Sam doesn't know. So she looks ahead into 2024 and she knows her household will make about $8,000 in charitable donations again. And so instead of taking the standard deductions 2 years in a row, she puts the $8,000 that she intends to give out in 2024 into a donor-advised fund. That is a tax-advantaged account for charities. And she does it before December 31st of 2023, and it's considered a charitable deduction. Now, remember, she already had $25,000 in deductions last year, didn't quite get her to the standard deduction amount. When she adds the $8,000 for 2024, and she did it on December 31st, 2023, she can add that to her $25,000. And now she's got $33,000 in total deductions for 2023. And that puts her over that $27,000 standard deduction line. So she gets credit for her charitable contributions. As a result, Bunching Betty gets an additional deduction of $5,300. And she still qualifies then for the standard deduction in 2024. So the point is, there are some techniques you can use to manage how you're paying taxes. And I know right now you're like, I kind of got that, but that was kind of fuzzy. And I know by the time you go to lunch today and have a blissful nap this afternoon, you may have forgotten a lot of this stuff and you won't remember how to do these things. And so if that's the case with you, I just want to say to you, reach out to us at Wealth Care Corporation. We'll help you. And you can do that by calling 417-882-1726 or visit our website at savingyou.taxes.com, because in Bunching Betty's case, it saved her about $2,500 in taxes just to bunch up those gifts and get them all recorded in 2023. Well, there's one final tax I want to talk to you about, Patrice, and then we will call it a wrap for this show. And that tax is the one that has to do with the step up in cost basis. The sixth tip I want to give you is don't lose the step up in cost basis. Now, let me explain to you what cost basis is. Cost basis is how much you gave for an investment. So when you have to pay taxes, you sell the investment for, let's say, $100, and let's say you only gave $75 for the investment. That's your cost basis, $75. So $100 minus $75, that's $25 left. That is your capital gain. Now you have to pay taxes on capital gains. So here's what happens a lot of times. I have all kinds of quack schemes come to me from people who are trying to inherit mom and dad's assets. And sometimes they read a book and they thought it was a really good idea to avoid probate. So they're going to have mom and dad give them the house now instead of later or whatever. I just want to say to you, stop it. Don't do that. You're going to screw it up. And one of the things that we see most often is we see people screw up the cost basis. Because, for example, if your mom and dad bought their house in the 1950s and they gave $40,000 for that house, and today that house is worth $400,000. So you've got $360,000 in gain in that house. If mom and dad deed that house over to you, you get mom and dad's basis on it, which is $40,000, meaning you're going to have to pay tax on that $360,000 gain. But did you know, if mom and dad die and they give you the house in death, and hopefully you didn't use a will to do that. Hopefully it either came through a trust or maybe it just came through a beneficiary deed. That's really perfect. And we have those available here in the state of Missouri and many other states as well. What that means is if you had gotten the house from mom and dad the day before you died, they'd have to pay a tax on $360,000 worth of gain. But if mom and dad died the next day and then you sold the house the day after that, you would have no tax on the $400,000 because you got the stepped up cost basis. So how you transfer properties is very important. How you transfer assets is very important in order to retain your stepped up basis. So don't go screw this up. Happens all the time. Well, not all the time. It actually only happens on days that end in Y. So don't make a mess of your taxes. If you'd like to learn more about how you can use appropriate tax strategies in your retirement plan, then there's two ways you can reach us. Give us a call, 417-882-1726, or visit our website, savingyouTaxes.com. Hey, Patrice, guess what?
What?
That's a wrap.
Wow.
Those are the 6 tax tips, things that people don't know about taxes. And that means that's it for this edition of The Truth About Taxes and Retirement. I'm Barry Watts, your host, reminding you that when it comes to retirement planning, if you don't get the taxes right, nothing else matters.
And this has been a production of the Wealth Care Corporation, found on the web at savingyouTaxes.com. The concepts discussed are for informational and educational purposes only and should not be implemented without first consulting with your own legal, tax, and investment counsel. This has not been an offer to buy, sell, or invest in securities, and this information is to be taken as educational concepts and not as specific advice for you. The lawyers and regulators like for us to remind you that all investment involves risk, and you could lose money. Past performance is never a guarantee of future results. Tax strategy services are provided by American Tax Strategies, LLC. Investment advisory services are provided by WealthCare Asset Management, LLC.
Thank you for listening to The Truth About Taxes and Retirement podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of SavingYouTaxes.com. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional tax and investment advice. Always seek the advice of your own qualified advisor with any questions you may have regarding taxes and investing.